Good afternoon, everyone, and welcome to Scotia iTrade's webinars. Today's topic is on advanced option strategies with the Montreal Exchange. Before we get started, let's do a quick audio check. If you can hear me clearly and the sound quality is great on your end, please click on that hand icon in your toolbar. Thank you, Alan. Phoebe, Nicole, Ralph, thank you so much. And if you are experiencing audio difficulties, you can always click on that sound check link or the settings link. And the setup window may show up in your secondary screen if you are using two monitors. As always, everyone is muted for sound quality purposes. And if you find that you did join using your computer speakers and are still unable to hear or the audio quality is not great, you're also welcome to dial in using your telephone. And don't forget to enter the access code and the audio PIN ID, which you will find in the audio panel. And also, just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. And we did get a chance to use that control panel right there. I do want to note that the GoToWebinar platform sometimes automatically hides the menu for you. And if that does happen, you can always expand clicking on that arrow icon. You're also welcome to view in full screen mode. And also you can click on that hand icon again at any time if you have any questions. And also feel free to type in your questions in the question panel, and our presenter will address them either as they come in or at the end of the session. And we are recording today's session, and if you did select yes on the registration page, we will email you the recording. Alternatively, you can access our past webinar recordings on our webinars on demand page under the Learn and Do More section of scotiaitrade.com, or also email us at education@scotiaitrade.com as well to request a copy of the recording. And you are also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. I do want to note that the handouts panel is not currently visible, but will be so at the end of the session. And you can download the handout just by clicking on that link in the handouts panel. And today's session is part of a learning series that Montreal Exchange offers. Advanced Option Strategies is part C of the Series 3 Mastering Options. And if you find that you haven't had a chance to view any of the past webinar recordings or past learning series, you're welcome to view them on our webinars on demand page as well, or sign up for future sessions in the series. And our presenter today is Jason Ayres. He's been an instructor for the Montreal Exchange for several years and actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global as well as founder of OptionSource.net. He's a derivative market specialist by designation. Welcome, Jason.
Hey there, Rose. How you doing?
I'm great, thank you.
Good, good. Sorry, you had me worried there for a second.
I just muted, that's why.
Good stuff, good stuff. So I guess we need to change presenter so I can share my screen. All right, perfect. So 1 second, folks. Make sure that we are sharing the proper screen. Okay, so let's get a quick confirmation in the Q&A box, or just a hands up, if you will, that you can indeed see my screen. Perfect. Good stuff. All right, everybody. Well, just an official thank you for joining in this afternoon. It looks like we've got a fantastic crowd here for today's presentation. As Rose suggested, we're going to be taking a look at what we would consider an advanced option strategy. More specifically, we're going to look at straddles and strangles. As always, we want to make sure that everybody is aware that the information that we're going to be presenting here is for educational purposes only, and you really want to understand the logistics and dynamics of the options market before you get into transacting these trades in your live account. So I'm going to just first of all start off with going through some of the common characteristics of these the two strategies. I want to touch on the concept of implied volatility. It's definitely something that we've looked at in a number of our different webinars, but I always like to reinforce the importance of understanding this particular concept and its the role that implied volatility plays within strategy selection. Then we'll look at the straddle, and I'll give you a quick platform example, by accessing the iTrade platform, and we'll look at executing the strategy, and then we'll do the strangle, and I'll look to do the same thing. So let's jump right in and take a look at some of the common characteristics. So the straddle and the strangle, although we are sort of collectively labeling these strategies as advanced strategies, are actually quite simple when you break it down. So really what we're looking to do is purchase a call and a put option at the same time. And the idea is that we anticipate a sharp or volatile move in the underlying security in either direction. So this is a strategy where we're not sure what direction the underlying security is going to go, but we feel that there's going to be some sort of an influence that's going to send it either higher or lower very, very quickly. We typically base this on a short-term outlook. So the expectation is that, maybe there's an earnings report, or maybe there's like Brexit's a great example as well. Something, where we think that there's going to be a very definitive sort of bit of information shared that is not currently factored into the underlying price, and it's going to either drive the share price up or down. Now, one of the important considerations about these two strategies, the straddle and the strangle, is that we actually have to take into consideration a higher break-even point, because if we think back to our options basics, the way that we actually calculate the break-even point of an options trade when we're buying a call option, for example, is we add the premium to the strike price of the contract, and that's where the stock has to be trading on expiration to break even. Similarly, if we buy a put option, we essentially have to subtract the premium that we've paid from the put option from the strike price of the put, and stock needs to be trading below that price point on expiration in order to break even. So when we purchase a call and a put at the same time, we need to add the two premiums together, and subsequently that net value becomes the value that we add to the option strike prices in order to figure out just where we're going to break even on expiration. So it's really, really important to consider the fact that we need a fairly significant move in the underlying security to take place, to break even and then subsequently profit. So let's touch on the concept of implied volatility here just briefly. So we want to understand that that we are buying a call option and we are buying a put option at the same time, which means that we have to be very sensitive to just the pricing of those particular contracts. So if we just look at the concept of volatility here briefly, remember that volatility, and implied volatility more importantly, is the price adjustment for risk. So implied volatility is going to be impacted by company earnings, pending announcements or mergers, economic or market conditions. So anything that is sort of suggesting uncertainty within the markets will in fact have an influence on the implied volatility variable that is factored into the price of an option contract. And so what we want to be looking at are really a comparison between two types of volatility. And again, a lot of this information is accessible through our past one of our past webinars where we focus explicitly on volatility. But just to give you guys a quick general overview, historic volatility is quantifiable. It's actually the past realized volatility of the underlying security, so how much the underlying share price of the stock, or ETF for that matter, has been deviating from its average price. So it's actually measured by the average deviation of the share price from its average price. The way I try to get people to think about it is if you have a price chart that you're looking at, and let's say you have a moving average, a 20-bar moving average, that is plotted along that price chart, the amount by which the price trades above or below that moving average would be considered as volatility. So the more the stock trades above or below that average, the higher the volatility measure, right? So that is measurable, it's quantifiable. What's a little more challenging to interpret is implied volatility. Implied volatility is the market's expectation of future volatility. It's the component of the option price that is trying to forecast what it is that the stock is likely to do within the time frame of that option contract. So it's the probabilities adjustment for the option price. What it does is it actually creates a distribution curve, and this might be a little, again, we won't get too deep into the mathematics of it all, but if we take a look at this normal distribution curve here, and we think for a moment that the stock is at $50, then there is a probability assigned to whether or not the stock is going to be below or above that $50 per share within a certain time frame, and then subsequently probabilities as to how much above or below over the course of the life cycle of that option contract. So in this particular example here, under normal circumstances, the market maker who is tasked in pricing the option contract value would essentially be suggesting that there's a 68.2% probability that the shares of the underlying security are going to be trading between $45 and $55, and subsequently they will factor that probability into the price of the option contracts within this range, and then that price, the price adjustment will then filter out to the in the money and the out of the money contracts. Now, what we want to recognize is that when market conditions change, the implied volatility can increase. And this is why this becomes very, very important to the strategies that we want to look at today, because what happens is as market conditions change, the market maker will then assess that there's a 68.2% probability that the stock is going to trade between 42 and 58. So you can see now that this range has widened out, and all of the option contracts that are at strike prices within this range will be adjusted accordingly. So the prices will increase for those contracts because there's a higher probability that they may be in the money on expiration, and then that price adjustment will filter out accordingly. The important consideration for us is that we can actually capitalize on this if we buy a straddle or a strangle when implied volatility is on the lower end of the spectrum, because what happens is really what we're trying to do is purchase the call and the put when implied volatility is relatively low, and as the stock begins to make a move either higher or lower, we can then capitalize on both the move in the underlying security, but also that expansion of implied volatility, which is impacting the price of the option contract. The inverse of that is that if we're not paying attention to the implied volatility of the option contracts, we might go and buy a call and a put, let's say the day before earnings, because we think there's going to be a huge move because of the earnings report. But we might buy those option contracts when implied volatility is extremely high, overpay for those option contracts, and then subsequently the stock may move to a certain extent one direction or another, but if we get a contraction of implied volatility, not only is it impacting the call option, but it's also going to impact the put option as well, and we could get we will get impacted by that, or the value of the position will get impacted by that, regardless of whether or not the stock has moved in a particular direction. So we really want to be sensitive to that. So the lower cost option, when we're looking at buying these options under periods of low implied volatility, once again allows us to take advantage of the increase in implied volatility leading into an event, as well as any sort of significant price move in the underlying security. So we can consider these strategies ahead of earnings reports, product launches, economic announcements. Like again, presidential election in the U.S. was an interesting consideration. Bank of Canada interest rate announcement. There's a number of different economic announcements, lawsuits or legal rulings, patents or product approvals, or just an indecisive market environment. Again, what we want to take into consideration is whether or not the implied volatility variable of the option contract is trading close to the historical, or whether it's trading higher than the historical. If it's higher than the historical, we want to be cautious of overpaying for the option contract. So let's take a look at the straddle here. So the straddle, once again, we're looking at buying a call and a put. It's going to be the same expiration, but what makes it a straddle is that we're going to buy option contracts, a put and a call, with the same strike price. So I was looking at, this is an example from back during the summer here, but looking at Imperial Oil, and it was trading at $41.20 at the time. And the idea is that the investor expects that the stock's going to be volatile, but not sure what direction it's likely to go. So we can capitalize on a large move in either direction by purchasing a call and a put option at the same time. Now, I should actually add that you don't necessarily have to do it exactly at the same time. So you could what we refer to as leg into the strategy. So you could buy a call option on IMO when you think that the market conditions are favorable for that purchase, and then you could wait and subsequently buy a put option, on the position to complete the straddle at a point when it's more favorable to buy the put. But in this case, if we're just going to do it all at once, the August, in this case, so it was July, so we're looking at 1 month out. The August call was trading at $1.10. The August put at the 42 strike was trading at $1.90. Now, if we buy 10 of each, right, we want to recognize that the net cost of the entire position is going to be $3, $1.10 for the call, $1.90 for the put. So it's a total of $3. We're going to buy 10 straddles, so that's $3,000, and that represents the maximum risk. Now, important consideration is that we have two break-even points to consider. The break-even point to the upside, to the downside is $39, and to the upside is $45. It creates what's known as a risk-reward profile, and so you can see with the straddle, what we have is the the strike price of the option contracts in the middle here, and in red we have the zone in which the strategy is not profitable. So on expiration, if the stock is trading anywhere between 39 and 45, as indicated by where these lines intersect the the price of the stock, then the position is going to be a losing position, and it's going to vary in terms of loss depending upon where the underlying shares are sitting. If the shares are sitting exactly at 42, recognize that the call option will be worth 0 and the put option will be worth 0, and as a result, that entire position will expire worthless. However, the probabilities, the likelihood of that happening are quite high, are quite low. Sorry, it's not likely that the stock is going to be trading exactly at the strike prices. So again, depending upon where the stock is above or below 42, that's going to represent the loss in the position. Where above the break-even points is where you're profitable. Now keep in mind that this is on expiration. You can close the positions at any time prior to expiration. So let's say, for example, if the stock took off to the upside very, very quickly in a short period of time, you could close the put option and get back whatever premium you can, and then subsequently continue to hold the call option to lock in profits and take advantage of the move to the upside. Similarly, if the shares drop very quickly, you could sell the call option and recover as much of the premium as you can, and subsequently, trade the position, just the put position, as the stock continues lower. So you don't have to hold until expiration, but these risk-reward profiles represent the break-even points on expiration should you decide to hold the position. Now, I just, for illustrative purposes, wanted to sort of put it into perspective of the underlying stock. And so you see here at the time we had the, this is a price chart of Imperial Oil, and it was trading at $42, $41.20 at the time, and we were looking at the strike price of 42. So you can see that our expectation is either the stock is going to be above within the next month, 45, or below within the next month, 39. And really the way that I try to judge whether or not the position is worthwhile putting on is it's just really looking back historically and assessing whether or not the stock does indeed have the potential to make those kinds of moves. So can the stock move $3 within a short period of time? You know, historically speaking, you can see that there have been quite a few price swings within a 1 month period that would suggest that there's sufficient enough historic volatility to get us where we need to be to break even and ideally profit. Now, once again, just to sort of touch on how one might manage the position, if within a short period of time the stock hit the break-even point and we still had 3 weeks left till expiration, well, it's high probability that your position is still going to be profitable because you've had a big move to the upside that's been impacting the calls. Yes, you will see a loss on the puts, but since there's still time until expiration, those puts will still maintain some value, which means that you may be able to offset the entire position early for a profit. And same goes if the shares drop significantly to the downside towards that break-even point. That's a really good time to step back and consider whether or not it's appropriate to close the position. Now let's take a look at how one might build this position on our platform. So I'm just going to share the iTrade platform here very quickly. And you know, I was actually looking at CCO, for example. So if we take a look at CCO, which is Kamiko, and we take a look just quickly at the charts. You know, we've seen over the last, let's just go a short period here. We've seen some pretty significant volatility in the price action over the last little while, right? So the idea might be that, you know, we could see a very significant continuation higher in the next couple of months, or we might see a significant rollover and continuation lower in the next couple of months. So really, this is what we're considering here. And again, not a recommendation, just an example. But, you know, you've seen a high here put in a relatively short period of time, and you've seen a low put in. So we're trading somewhere in the middle here. Maybe we're going to see a continuation, maybe we're going to see a sell-off, but let's try to position in such a way that we could take advantage of a move in either direction. So with that in mind, we can see that the shares are currently trading in and around the $16.80 level. So what we could do is the first trade that we want to make, let's say, for example, is going to be to purchase a call option. So I just want to make sure that I'm using the right account here. So we're going to go in and we're going to type in CCO and we're going to type in Canadian markets. We're going to type in a call option, and my idea is giving it out to March, and we're going to use the 17 strike call option in order to do this. Now, what we're going to have to do here is we're going to enter each trade independently of one another. So this is sometimes a bit of a challenge for folks to sort of wrap their head around, is that even though this is a combination strategy, we'll actually be entering the trades independent of one another. So we'll be buying a call option first, and then we'll be buying a put option second. So we're going to buy to open. In this case, I'm going to say 10 contracts. And we're going to go with a limit order. Now you can see that the ask price is 85 cents. So we'll put a limit of 85, just so we can get execution here. We'll make this order a day order. Preview our practice order here. Just make sure everything is looking good. All right, so we're going to buy to open 10 CCO contracts in the Canadian market. It's going to be a call option expiring March. At the 17 strike, we're willing to pay 85 cents. So once we're satisfied with that, we can go ahead and first of all just make sure we're able to execute this. So we're going to, okay, so we're going to submit the order. So just bear with me 1 second here. All right, so so we put the order in. We're just going to view the order just to see if it's been filled, and we can see that immediately that's been filled. And I'm just going to go ahead and we're going to do another trade here, and we're going to buy the put option. So once again, it's going to be CCO, not CCCO, CCO. Sorry, options, and CCO, Canadian market. This time it's going to be a put. Same expiration out to March, same strike price. That's what makes it a straddle, and we're going to buy to open 10 contracts. We're going to go to limit, and in this case the ask is $1.04, so we'll just for the sake of getting the trade executed, we'll type in the $1.04, preview the practice order. All right, and submit the order. All right, so quite likely it's been executed. So both those orders have been filled. So let's just go and take a look at our accounts here very quickly, and we want to go in and take a look at. All right, so let's go to our. Okay, so what we're going to see here is we're going to see the two positions open, and you're going to see initially both positions are going to be down a certain extent because we have the spread differential between the bid and the ask, and we went on the ask side, and we have to exit the trade on the bid side, so that means that that spread is going to be reflecting as a loss right now, plus we have commissions to account for. And so what we want to recognize is this is a strategy that we need to be patient with, and that's a very important consideration, because what you're going to find once you have this position working in the market is that stock may go up a little bit and your call will make money, your puts will lose money. Then the next day the stock will go down a little bit and your calls will lose money and your puts will make money. And so you're going to get this little bit of a roller coaster ride until finally you see a fairly significant move and the position starts to work in your favor. You can see since these are two independent contracts, we can monitor them collectively, but subsequently manage them independently, right? So again, if we feel that the stock's taking off to the upside, we can close our put option. If we feel the stock's taking off to the downside, we can close our call option and manage the other side. But even though we have the two positions in our account independently, we are going to be watching them and considering our actions based on the fact that we've created this combination strategy, right? And of course, if there are any questions, which I'm not seeing any yet, we can certainly take some time towards the end of the session, right? So there's an example of a straddle, and once again, the reason why we refer to it as a straddle is because you'll notice we've used a 17 strike call and the 17 strike put, so we're straddling the strike price. The next position or next strategy I want to look at is the strangle. So really the only difference here is that we're going to be using different strike prices. So the put is going to have a lower strike price than the call option typically. Now this becomes an interesting consideration when we want to try to favor, let's say, one side, one direction over the other. So for example, if we think back to option Greeks, and we recall option deltas. The closer to the money the option contract is, the higher the delta, which means it's more sensitive to a move in the underlying security. So if we're creating a strangle and we're bullish, we're to a certain extent bullish the stock, but we want to build a bit of a hedge in place, we could buy a call option that's close to the money with a high, or even in the money with a high delta. So it'll be impacted much more significantly by a move in the underlying to the upside. And then we could buy a put option further out of the money at a much different strike price with a lower delta, which is going to be cheaper, and it'll act as sort of like a hedge in the event that we're wrong about our directional bias. So this gives us some flexibility to position ourselves in a way that favors a particular market direction. At the same time, building a hedge in place if we're really wrong about what our expectations are. So once again, we'll take a look at Imperial Oil as an example, and you'll see that stock's still trading the same, but what we're doing is we're trying to benefit from a large move in the share value, but at a much more reduced cost. And so you can see, in fact, that if we take a look at the 44 strike call, that's only asking 40 cents, whereas the 40 put is asking $1. We're in fact favoring a little bit more the bearish side, because with the shares trading at 41.20, we're actually more closer to the put option strike than we are the call, and that's why the put premium is more expensive than the call premium. And so if we were looking at the deltas of each, the 40 put would have a higher delta than the 40 call. You can see that the net result here is that we've reduced our cost down to $1.40 for this combination versus the $3 that the straddle would have cost. So the 40 by 44 strangle is going to cost us $1,400. That represents the maximum risk of the strategy. But our break-even points, you'll notice, interestingly enough, are not all that much different, because we are, in fact, using further away strike prices than we were with the strangle. So the break-even point to the downside is 38.60, and the break-even to the upside is 45.40. Once again, we take a look at the risk-reward profile, and what you'll notice is that in this situation, there's actually a much wider what I call a kill zone, for lack of a better word. So what I mean by that is if we take a look at the strike prices here are, as I mentioned, the 40 and the 44, which means that if the shares are trading anywhere between 40 and 44 on expiration, then both options will expire worthless. Conversely, if we look at the straddle, and sorry for my drawing here, but in order to to be down to zero, the stock price had to be trading at the strike price of both options. So there's a much wider kill zone in the strangle here that we want to worry about. And of course, on expiration, the shares need to be trading above or below the break-even points. Again, if we take a look at the chart here, you'll see that instead of our call strikes being at one point very close to where the shares are trading at, the call strikes are actually further away, but the put strike is much more closer to the underlying current share price than what the call strike is. So you can see there's your sort of wide kill zone, if you will. If the shares are trading anywhere within this range on expiration, then all options will expire worthless. That being said, your maximum risk on 10 contracts is still $1.40 versus $3. So you got to weigh that out. The way I look at it is the straddle is sort of, in my mind, a good sort of general approach to trading a non-biased directional opportunity. Whereas if you think that there's going to be a real significant move in one direction or the other, or you want to favor one side over another, then you can make those adjustments by playing with the strike prices and ultimately creating this straddle. Strangle in this case. So let's take a look at an example on the platform once again. So we're going to just go back to our platform, and I was more or less kind of looking at the XIU as an example. So the XIU, let's just take a look at quotes and research here. Most people are probably familiar with the XIU. The XIU is essentially an ETF that tracks the S&P TSX 60. So it's an exchange-traded fund. If we take a look at the charts, and again, this is not a recommendation, but more or less just a way that we can look at applying a strangle. You'll see that essentially we've had a very, very nice uptrend for quite an extended period of time here, since the beginning of last year. So the question becomes, are we going to, over the next couple of months, finally get a little bit of a sell-off? Because, hey, in the ebb and flow of the markets in general, markets go up and they come down. That's what makes a trend, right? It's just, it's the way it goes. So what we could conceivably do is we could say, okay, I want to buy a put option where the stock is trading at, or where the ETF is trading at presently. So I want to go in and I want to purchase a 23 strike put at the money, so that if the XIU starts to sell off, I'm positioned close to where the shares are trading presently, and I can take advantage of that move. But just to be on the safe side, because I am going against the trend, I'm going to turn around and I'm going to buy a 25 strike call option, so that if the shares start moving higher, at the very least, while I'm losing on my put, I can be gaining on the call option to help offset some of that loss. So in order for us to do that, we're going to set this trade up exactly the same as we did for the straddle. So we're going to go to our trade platform here. We're going to go to options. We'll first make sure we select our appropriate account. First position we're going to put on, just for the sake that this is our directional bias here with this example, is we'll look at buying a put option, and in this case I'm going to go out to May, so I'm going to give myself a little bit more time. So rather than this being necessarily an event-driven short term, I'm going to give myself a couple of months to see this play out. So we're going to buy a put, and again it's going to be at the 23 strike. And so what we're going to do here is we're going to buy to open, again 10 contracts, and we have to go in at a limit order. So you can see the ask price is 57 cents. So we'll put in an ask of 57, make it a day order, preview. Okay, so we're just going to double check once again. Always important when you're entering a trade to ensure that you are reviewing the specifics of the trade. We're going to buy to open 10 XIU contracts in the Canadian market. They're going to be put options expiring in May, 23 strike, limit 57 cents. This order is going to be good for a day. So we'll submit this order. All right, I'll just check the view the orders real quick. You can see that XIU put's been purchased. So now we're going to go back to the trade platform again, and we'll go through this the logistics of this one more time. XIU, it's going to be in the Canadian market, it's going to be a call option. Once again, it's going to be out to May, and we're going to go. So at this point, it's only for some reason we're only able to access as far as great a strike price as the 24. So we'll look at utilizing the 24 strike, being an out of the money option. We'll buy to open that 10 contracts, and we will create a limit order. Now you'll notice this one, the ask is only 19 cents. So you can see the difference between the expectations of the market. The put option is more expensive because it's close to where the underlying is trading at presently. The call option is cheaper because it's further out of the money. The market is pricing in a lower probability that XIU is going to be trading at or above 24 between now and the third Friday of May, so it's cheaper. In this case, again, 0.19. All right, so it's going to be a day order. Preview the order. All right. So once again, buy to open 10 contracts of the May 24 strike call options on the XIU. We're willing to pay 19 cents. Submit the order. All right, we're just going to go very quickly to view the orders, and that's filled as well. So if we circle back to our account and just go account details, then access our practice account here, and we go down. There's your two contracts here at this point. So you can see that that's basically going to cost us the 70 cents, right? So 70 cents is the maximum cost for these for our straddle. For our strangle, and we call it a strangle because we're using two different strike prices here, and so our break-even point is going to be 22.30 on the downside and 24.70 on the upside, and that's ultimately where the shares need to be trading on expiration for this entire position to break even. And once again, we can manage each position independently if that's how it's playing out, and we feel that there's a benefit in doing so. The other interesting consideration here as well, not to get too advanced, but because you're dealing with independent contracts, you could actually do ratio straddles and strangles as well. So, for example, again, if I was favoring more so the bullish side, I could buy 10 call options and 5 put options. If I was favoring the bearish side, I could buy 10 put options and 5 call options. You could also do calendar straddles and strangles. So I could buy a long-term call option to trade a longer-term directional bias on the particular shares. And if I was concerned about some short-term risk, maybe there was an earnings report coming out, I could just buy a near-term put option to offset that near-term risk, and it's going to cost me less as well. So there's a lot of different variations that you can apply to the traditional straddle or strangle position to tweak it to help you meet your investment objectives, right? So just to summarize before we open it up to questions, folks, what we want to reinforce is that as an investor looking to utilize a straddle or a strangle, we must be anticipating a sharp move in either direction. So again, in general, we don't care whether or not the stock is going to move higher or lower. We really just need to be confident that it's going to make a big move in one direction or the other. Now, that said, we can adjust the configuration of the strategy or of the strike price selection in order to favor one side or the other, and we could also adjust the number of contracts as well in order to favor one direction over another. Benefit is that we can profit regardless of which direction the share price goes. We have to understand that the strategies have higher break-evens because of these two premiums being purchased, and we also need to be sensitive to the implied volatility of the options. Now, quite often I get a question about where to find implied volatility versus historic volatility, and the CBOE has a great resource, and it actually is helps it can help sort of get that help you visualize. So for example, if I were to take a look at XIU options, this is the CBOE, and it's a free service if you go into trading tools. So you can go in and look at Canadian stocks. So I'm typing in XIU Canada. We can select the Go button, and you can click on the volatility chart. And what we want to see is that implied, which is in gold here, is close to the historic volatility. So you can see in certain circumstances, you'll notice that implied volatility was significantly higher than historic. That would not be a good time to buy a straddle or a strangle. Whereas in this example here, where implied volatility is lower than historic, that would be a good time to purchase the straddle or strangle. We could take a look at just let me erase the drawings here. So you could type in any Canadian stock here that you might be interested in. Here's in Canada, for example, and we can take a look at the volatility chart. And again, you've got in this case you've got implied over historic, so you might want to be sensitive to that. But this is a great way to give you a general idea as to whether or not options are priced relatively close to historic volatility, and you could take advantage of a significant swing in the price action and implied volatility, or not. Another one that might be interesting. Sorry, what am I looking at? BB. Bear with me here. You take a look at some of the gold stocks here. Oops, just G on the Canadian market. Bear with me here, guys. There we go. So, right now, implied volatility versus historic volatility is relatively close for Goldcorp. You know, all of these observations help us determine what strategy might make the most sense. Now, I see a couple of questions have rolled in here. Min has asked, should the strike price in either strategies be near the money? What is the right approach to select? So really, it just depends on your expectations. When you go near the money, as I was mentioning, you are buying options that have a higher delta, which means they're much more sensitive to the underlying security price movement, and they can be but it's going to be more expensive. But if we think about it, if you go, let's say, if you're doing let's say you're doing a straddle, if the stock's at $20 and you buy a $25 call and a $25 put, your $25 call's out of the money, but your $25 put is in the money. So if you're looking to if you want to make adjustments, that's where the strangle comes into play. Typically for a straddle or a strangle, I would look at, if I'm trying to create a neutral position, what I'm looking at is buying a call and a put whose deltas are about the same, right? So that's typically an at-the-money call option and an at-the-money put option, or you could make an adjustment slightly within the strike prices, but your focus, if you're trying to create a specifically neutral position, is looking at buying a call and buying a put with similar deltas. And that might mean, as I said, choosing different strike prices. So Aaron's question is, so this is done without buying the underlying equity first. Yeah, this is a stock replacement strategy. You are not participating, or you don't own the underlying security. You are looking to participate utilizing options. Because you are buying the call and buying the put, you're not trading on margin. You would need to have sufficient enough cash in your account to buy the call and to buy the put. The only time, and you're not obligated to buy those underlying shares. So Aaron's question is really, do I need to have enough money to take a position in the underlying shares if you're right about the direction and one of the options are in the money on expiration? The answer is no. Number one, you're going to be closing the position before expiration. Which means that you don't have to worry about automatic exercise, and it's up to you to determine whether or not you take on the underlying shares. So if you want them, yeah, you need to have enough capital. But if all you're looking to do is participate in the appreciation in the option contract, number one, depending on which direction. The out-of-the-money option is going to expire worthless. You don't have to worry about it. And the in-the-money option, as you're right, as I said, you just sell back to the market, and you don't have to worry about taking on the underlying security. The broker only requires at the initial onset of this trade for you to have enough money in the account to buy the call and to buy the put. Right? So hopefully that answers your question. Graydon just had a question as well. When the call and the put implied volatilities are different, how might that factor into the choice of strategy? So general rule of thumb is, if you're going to be a net buyer, so if you want to buy a call or you want to buy a put option or you want to do a straddle or a strangle, you want the implied and historic to be relatively close to one another. Like an ideal scenario is when they're within 5 to 10% of one another. When you get into a situation where you see implied volatility extremely high compared to historic, that's when you might want to look at doing a spread strategy, like a bull call spread or a bear put spread, because what you're doing is you're offsetting the implied volatility variable, among other variables, but you're offsetting the vega of the position, which is the measure of implied volatility. So if you're a buyer, you want implied to be close to historic. And if you want to participate and implied is higher significantly than historic, that's when you want to look to spread strategies to help offset that. So hopefully, Graydon, that answers your question as well. So that little tool that I was using, as I said, it's found at the CBOE, cboe.com under tools and resources, and then you can go to strategy planning tools, and you can then go to volatility optimizer, and it's a nice free little service that you can use free service that you can use, and you can get all Canadian stock quotes on that. So it's a great little complement to helping make better trading decisions using options. So on that note, guys, just a couple of more considerations here before we wrap it up or answer any more questions. The straddle is more expensive than the strangle, but the maximum loss occurs if the shares are at the purchase price, which I said is pretty improbable. The strangle is cheaper, but the maximum loss takes place between the purchase strikes, and you need to be cautious of that. To learn more, guys, we got lots of information at optionmatters.ca. Montreal Exchange has completely overhauled the blog site, so it just looks fantastic, and a lot of great information there, and articles on real-time relevant market observations. Lots of investor trading letters, videos and webinars, trading guides and strategies, as well as different calculators and simulators to be found. So when you have some time, check out m-x.ca or m-x.tv, and you'll be able to check out some of the different resources there. So on that note, I'll pass it back to Rose, and happy to answer any questions moving forward.
Thanks very much, Jason. And as Jason said, you can type in your questions while I do the closing remarks. You can access our webinar recordings on our website from next week on, and also don't forget to fill out that short survey that does pop up after you exit today's session. And also mark your calendars. This Thursday, January 26th at 1 p.m. Eastern Time, we have the market guys joining us to present on trading the double top. And Montreal Exchange is back with us on Tuesday, February 28th at 1 p.m. Eastern Time to present on Introduction to Canadian ETFs and ETF Options. And you're also welcome to register for our other webinars on our seminar and webinar calendar under the Learn and Do More section. And also, again, past webinar recordings can be accessed on our Webinars on Demand page. And I do want to note that the handout is already available in the menu, so feel free to download that. And if there are no more questions, I just want to thank Jason for sharing his insights, and thank you all for joining us. And if you do have any other questions that may come up after today's session, feel free to email them at education@scotiaitrade.com, and we would be happy to forward them to Jason. And let me just check the question panel to see if there are other questions.